there's a cycle in the gold market where the S&P 500 and gold's market cap fluctuate against each other, and sometimes they're trading at 1-to-1, and other times they're trading at this massive premium of the S&P 500 over gold. And lately we've been in a situation where the S&P 500 was vastly more valuable than the market cap of gold, but we're heading back in the other direction now. And if we go back the way previous cycles have gone to one-to-one, then that takes the price of gold to $15,000 or $20,000 an ounce. So that's one metric that you can look at that's fundamental, that gives you a reasonable way of estimating the value of gold.
In April, the People's Bank of China reported a significant decline in gold buying, expanding its reserves by just under 2 tons. Despite this deceleration, it marked the 18th month of increased Chinese gold holdings. Since October 2022, when China resumed reporting its gold purchases, it has added over 300 tons to its reserves. This trend is part of a broader global phenomenon where various entities, including countries, companies, and individuals, are stockpiling precious metals and other commodities. JohnRubino, the former founder of DollarCollapse.com, attributes this behavior to a perceived impending currency crisis. He argues that as currencies devalue, holding tangible assets like gold and other commodities becomes a more stable store of value. In addition to China, other major gold buyers in April included the National Bank of Kazakhstan and the Reserve Bank of India, each purchasing 6 tons, followed by the National Bank of Poland, 5 tons, the Monetary Authority of Singapore, 4 tons, the Central Bank of Russia, 3 tons, and the Czech National Bank, 2 tons. According to Krishan Gopal, senior analyst for EMEA at the World Gold Council, while the gross gold purchases in April were similar to those in March, sovereign selling had significantly dried up, resulting in a substantial net gain by central banks. Historically, the market capitalization of gold and the S&P 500 have fluctuated relative to each other. Recently, the S&P 500 has been significantly more valuable than gold, but this trend appears to be reversing. Rubino suggests that if we return to a 1-to-1 ratio, as seen in previous cycles, the price of gold could rise dramatically, potentially reaching $15,000 to $20,000 per ounce. Currently, the SPX gold ratio forms a rounding top pattern, a bearish signal indicating a potential decline in the ratio. This pattern suggests that the ratio may continue to decrease, implying a period where gold is likely to outperform equities. The rounding top pattern in the SPX gold ratio aligns with a significant resistance level reached in March 2024, coinciding with a major breakout in the gold market from the pivotal area of $2,075. Join us as we delve into JohnRubino's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications.
What we're seeing is happening for different specific reasons in different sectors of the commodity space. But it all amounts to the same thing. People are converting their currency into real stuff. And, silver, which you mentioned, is a great part of that story because it has basically 2 things going for it. One is that industrial applications are growing for silver, and the demand for silver in solar panels and satellites and electric cars, and it goes on, is rising at an accelerating rate. And right now, silver is in deficit, meaning that the world's silver mines aren't producing enough silver to cover what industrial users and investors are demanding right now. So we're running through the above ground stocks of silver. And when that runs out, then you go from deficit to shortage, which usually means prices have to go up to increase the supply somehow. And an analyst just came out lately with a time frame for that, and he said 1.5 to 2 years before we run out of above ground silver, and the price mechanism has to really kick in order to allocate what there is out there. And India, for instance, is a good example of the response to that because they just imported more silver in the first quarter of this year than in all of 2023. And they're normally a big importer of silver, so that we're talking serious numbers in that case. And they, at the same time, repatriated 100 tons of gold from London back to India. So take what India is doing and kind of spread it out around the world, and you've got different entities, whether they're countries or companies or individuals, doing variations of that. They're buying silver coins, or they're stockpiling gold because they see a currency crisis coming, or they're buying every bit of copper they can get their hands on, because if we're going to electrify the world, it's going to take 3 times as much copper as comes out of today's copper mines. And then what are we going to do then? And so everybody has their reasons, but it all involves a thought process in which they conclude that the currency that they have is worth less than the commodities they could buy with that currency. And you reach a point where it dawns on everybody that we're literally running out of this stuff, which is another way of saying we've got tons of currency relative to the amount of commodities that there are out there, and we really need to convert all the currency that we have into these commodities if it's at all possible. And so that, within the framework of the crack-up boom, that means the price of real things goes through the roof, but not because there's a huge increase in the supply of currency. It's not inflation as we typically envision it. It's a loss of faith in the amount of currency, or the currency that exists now. And so nobody just wants to hold those currencies anymore. So that's a conceptual difference that works out to the same thing, which is that the price of real stuff goes through the roof. And the market value of financial things like government bonds and bank stocks and Goldman Sachs equities and things like that tank. And you get a revaluation in both directions, where commodities relative to the size of the global economy, they go up, while financial assets relative to the size of the economy go way back down. There's a cycle in the gold market where the S&P 500 and gold's market cap fluctuate against each other, and sometimes they're trading at 1-to-1, and other times they're trading at this massive premium of the S&P 500 over gold. And lately, we've been in a situation where the S&P 500 was vastly more valuable than the market cap of gold, but we're heading back in the other direction now. And if we go back the way previous cycles have gone to 1-to-1, then that takes the price of gold to $15,000 or $20,000 an ounce. So that's one metric that you can look at that's fundamental, that gives you a reasonable way of estimating the value of gold.
Silver prices continued to gain ground for the third successive session, trading around $31.50 during Asian hours on Friday. This appreciation of the gray metal is largely attributed to rising speculation about a September interest rate cut by the U.S. Federal Reserve. This speculation has been fueled by the European Central Bank's recent decision to implement a 25 basis point rate cut on Thursday. A market analyst, JohnRubino, notes that significant corrections are expected in any robust bull market, including commodities. Silver recently experienced a substantial rise from the low $20s to the low $30s, marking a considerable gain. Naturally, such an increase led to investors' profit-taking, causing a price correction. Technically, the silver market is seeing fresh buying interest. Open interest has increased by 4.8%, reaching 23,770 contracts, indicating that more traders are entering the market with long positions. Rubino offers some crucial advice for investors. Avoid the fear of missing out. He suggests adopting a more measured approach to investing in silver, such as dollar-cost averaging or placing lowball bids, rather than making large, aggressive purchases. Let's get back to the interview.
The best bull markets still have brutal corrections in them. So what we're seeing right now is to be expected after the nice run. Silver went from the low 20s to the low 30s. That's a good run by any standard. And for it to be correcting from there, because when something goes up by a third, it creates a lot of people with profits to protect. And so the normal way to respond to that is to sell some small amount of your position. And that pushes prices down and brings in other people who wish they'd sold at the very top, but now don't want to be left out. And so you get a correction. And that's probably all that's happening with precious metals right now, because it does feel like we're in a legit commodities bull market, which means buy the dip in not just gold and silver, but uranium and copper and many other things. But at the same time, the economy is due for a recession, and we're seeing a lot of not really headline numbers yet, but under the surface numbers that are pointing towards a slowdown. And with stocks being wildly overvalued and most of the financial sectors of the world being overleveraged right now, a recession is a dangerous thing. So we need to be paying attention to that too, because that would affect precious metals if we tip into an equities bear market and that creates a generalized recession. Then we could have another 2008 or 2020 when stocks tanked and it pulled precious metals down along for the ride. In both cases, they bounced off of that bottom. We had a really nice V bottom where they just took off because the Fed stepped in and started easing. So that whole thing could repeat. And that would be bad in the short run for precious metals and phenomenally good in the long run. So the takeaway there is don't give in to fear of missing out in markets like this. Don't just jump right in all at once because you might be doing it right before a big correction. So keep buying, but do it in a dollar cost averaging way or with low ball bids or whatever. Or if you're in the stock market, write put options as a way of getting stocks at a discount. And do keep buying, but don't buy in a really aggressive way that puts you at risk of a sudden correction.
Given the current economic climate, with central banks worldwide, including China, continuing to accumulate gold as a hedge against potential currency devaluation, and silver gaining momentum due to speculations of interest rate cuts, how do you see the future of precious metals evolving in the next few years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.